Hello students, welcome to Accounting Explained at Account-Wise Academy. This is Latha Venkateshwaran. This is the part 2 video on Introduction to Capital Budgeting. In this video, we are going to see from the exam point of view, so that if you get any theory question on capital budgeting, it will be very easy for you to answer and get full marks in the exam. Meaning of capital budgeting. This I have explained clearly in the part 1 video, Introduction to Capital Budgeting. Now let us have a recap of the meaning of capital budgeting in a brief way. So the term capital budgeting refers to a long-term planning for proposed capital outlays or expenditure. So we are going to plan this for a long period for some capital outlay or expenditure for the purpose of maximizing return on investment. Investment here is this capital outlay or the expenditure which we are going to spend for that investment. Okay. Till now we have been seeing capital budgeting or talking about capital budgeting. Now we are going to see the steps involved in implementing that capital budgeting. It may be called as a steps or processes. Okay, so first is identification of profitable investment proposal. Proposal is a plan or suggestion which is given in a written or a formal way, okay, to others, particularly our senior authorities when you are in a business. So we have to identify profitable investment proposals. Screening and selection of right proposals. You may have got some 10 to 20 proposals, okay, in your hand, but you have to select the right proposal which is going to give you maximum returns. Evaluation of measures of investment worth. So how you are going to evaluate the investment? On the basis of, first is profitability, on the basis of returns, and uncertainty. Uncertain condition in the market, whether your product is going to go ahead accepted by the customers, or if the government is going to increase taxes in the near future. All these are uncertain. Economic conditions are uncertain, and the risk involved in taking that project. Establishing priorities. How are you going to establish priorities? Uneconomical and unprofitable proposal should be rejected upfront. Okay. Final approval and preparation of capital expenditure budget. So after you have selected the right project, you have to get the final approval from the required authorities and start preparing the capital expenditure budget after you have got the final approval from the authorities. Implementing proposal. When you come to the stage of implementing proposal, from that stage it is not going to be called as a capital expenditure proposal. It is going to be called as capital expenditure project, and this stage is called as project execution. From here onwards it is going to be called as a project. If you are going to change the factory from one location to another location, so that is called as a relocation of factory project. Okay. Review the performance of project. You have got the project now. You have executed the project. You are going to review the performance of project. How we are going to review? By seeing the profits it's going to make on the investments which we have made. Classification of capital budgeting or the types of capital budgeting. First one is replacement projects. These involve replacing worn out equipment. When you want to replace an equipment which has reached a stage of not working, or the repair cost is more than buying that equipment itself, then we have to, that project is called, or that expenditure is called as a replacement project. Or choosing between different equipment options. You have two equipment options. For example, you have to buy a machinery which is operated by human beings, or a machinery which is going to be operated by robots. So these are all the different equipment options which we can make while replacing the project or while doing capital budgeting. Analysis can be detailed for this decision. So analysis should be done in a detailed way, and we have to select whichever gives us the more returns or the maximized returns, we have to select that project. Next is expansion project. These aim to grow the business and involve more uncertainty than replacements. So expansion means, for example, if you are going to expand your factory, we are in one location A and you are going to set up a new factory in another location B. This means you are expanding your business, right? So it is very uncertain. If you are going to expand your business, then the market should be very strong for our products to go and reach the customers. So it is very uncertain. Careful consideration is crucial. We have to make a careful consideration before going for the expansion project in a proper way. New products or services. These projects have the highest level of uncertainty of all the capital budgeting types or classifications. New product or service is the most highest level of uncertainty. Okay, that has the most highest level of uncertainty and require complex analysis. It is very complex to do the analysis for this new product or services because it's very difficult when you are going to launch a new product. We don't know how the customer reaction will be there for that project. We cannot, that psychological analysis should be done and various analysis should be done, and it involves broader involvement in the decision making process. So even the decision making process becomes very difficult and cumbersome. Next is regulatory, safety or environmental projects. Regulatory means if there is change in tariffs by the government and if you are in the company business of importing and exporting goods. So for change in the tariffs, we have to make a project that is called as regulatory. Safety. For example, you can take workplace safety. It is very much necessary for keeping the workplace accident free. And the measures taken by you for the safety of the workplace is safety project. Next is environmental projects. For example, if you are a leather manufacturing company and the pollutants which come out of the factory, okay, polluted water which comes out of the factory should not get mixed with the common water used by the public. So we have to take all the measures that water is clean, polluted water is clean before it comes to the normal water used by the public. So that project can be called as environmental projects. So these projects are often mandated by external parties and they will not generate direct revenue. But these are all very much necessary for the continued operation of the business. Sometimes high cost might force closure of the related business unit also. Other projects. Some projects fall outside typical analysis. These projects do not come under the classification of the capital budgeting till now we have seen. They might be pet projects or highly risky ventures. Pet projects we can see when the owner of the one business wants to set up a helipad on the top of the roof of the factory or his office. Then it is not going to generate any revenue. It is only a pet project of the owner of the business. So the analysis required may differ. Similarly, highly risky ventures. If you are going to take a highly risky venture, it is of high cost and the risk involved, whether that project is going to be executed or if it is executed, whether it is going to give us returns, that are all very uncertain and it's very high risky, then the evaluation will be different for that projects. So these projects may require alternative evaluation methods. Types of capital budgeting. Capital expenditure can be of two types. Capital expenditure increases revenue and capital expenditure reduces cost. Capital expenditure increases revenue. It is the expenditure which brings more revenue to the firm. How it's going to, if you are going to incur that expenditure, then you are going to increase the revenue. Example is expanding the existing production facilities. When you are going to expand the existing production facilities, your market is going to be increased so that your revenue is also be increased. Development of new production line. So when you are going to develop a new production line, when you only know that the business is going to grow, right? So when you have all the opportunities for the business to grow, you are making a new production line and your profits will increase. So that increases the revenue. Okay. Next is capital expenditure reduces cost. Such a capital expenditure reduces the cost of present product and thereby increases the profitability of existing operations. So these types of expenditure will decrease the cost of the present product, okay, and thereby the profit will be increased. When you decrease the cost, profit will increase, right? So that will happen. Example of this is replacement of old machine by a new one. You have a old machine which is very worn out and the repair cost and the maintenance cost is very high. So now you are replacing with a new one. What will happen? Your repair cost and the maintenance cost is nil now with a new machinery. So your cost is reduced. Now we are going to see types of capital budgeting proposals. So proposal is the plan or suggestion given in a written or a formal way. No. So that types of capital budgeting proposals which we are going to see. A firm may have several investment proposals for its consideration. Okay, it may have so many proposals will come to it. It may adopt after considering the merits and demerits of each one of them. For this purpose, capital expenditure proposals may be classified into independent proposals, dependent proposals or contingent proposals, mutually exclusive proposals. Independent proposal. These proposals are said to be economically independent, which are accepted or rejected on the basis of minimum return on investment required. So they require only minimum return on investment, and on the basis of it, it will be accepted or rejected. Independent proposals do not depend upon each other. Okay, they do not depend upon each other. That's why it's called as independent proposal. For example, if an automobile company that manufactures light vehicles, okay, decides to manufacture heavy vehicles like lorry now. Light vehicles, we can say scooter, bike, etc. It will have investments for both, but each one will be unaffected by each other. So it will have investment for both light, maybe car can also be called as light vehicles and heavy vehicles. So each investment will be different and each one is not dependent on the other. Okay. Next is dependent proposals or contingent proposals. In this case, when the acceptance of one proposal is contingent, dependent upon the acceptance of other proposal, it is called as dependent or contingent proposal. For example, construction of a new building on account of installation of new plant and machinery. You are going to install a new plant and machinery. For that, you need a new building. See, that construction of new plant and installation of new plant and machinery depends on the construction of new building. So it is a dependent proposal. Example, okay. Mutually exclusive proposal. Mutually exclusive proposals refer to the acceptance of one proposal results in the automatic rejection of the other proposal. Then the two investments are mutually exclusive. In other words, one can be rejected and the other can be accepted. It is easier for a firm to take capital budgeting decisions on such projects. So, mutually exclusive proposals are the proposals that compete for the same resources such as time, capital and market share. So when making a mutually exclusive proposal, you must choose one proposal and the other will be rejected. Methods of evaluating capital investment proposals. Traditional method, time adjusted method or discounted cash flow method. Traditional methods are grouped into the following: payback period method or payout method. Improvement of traditional approach to payback period method. What are they? Post payback profitability method, discounted payback period method, reciprocal payback period method and rate of return method or accounting rate of return method. Next is time adjusted or discounted cash flow method. Under this we have net present value method, internal rate of return method, and profitability index method. With this, we are finishing the introduction to capital budgeting. Do like our video and share it with your friends if you find it helpful. Subscribe to our channel, which will encourage us to make more videos like this one. If you would like to inquire about the accountancy classes which I take, or to get more worksheets for problems with solutions, contact us at acct.wiseacademy@gmail.com. Thank you for watching.